Ashutosh Phatak, a man who created over 4,000 ad jingles in a
Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines at this hour. Oil prices are trading at their lowest levels since January as trade tensions continue to weigh in on global demand. The Norwegian parliament directs its sovereign wealth fund to sell stake in oil and gas explorers. The world's largest sovereign fund holds stake in 4 Indian companies. Pricewaterhouse's resignation letters to Reliance Capital and Reliance Home Finance point to suspicion of fraud at the firms. And cyclone Vayu will make landfall in Gujarat today. More than 3 lakh people have been evacuated. Trains and air services will be affected. Well, please be mindful if you are indeed traveling. Please make sure that you check up on the status of your flights or trains before you get out of your houses, at least in the affected areas. However, let's take a look at the trade setup for the day. It promises to be a start which will be, well, lackluster to say the least, or maybe marginally in the red, because the world markets haven't looked all that great. After 6 or 7 days for the MSCI World Index, there is a bit of a pull back. So global stocks have indeed caught some breath after a 7-day rally. This is, remember, the MSCI All Country World Index. The US markets have been correcting for the last 2 days, but the All Country Index corrects for the first time in last 7 days. So good pullback in the month of June, and then now taking a breather. It showed in the way the world markets are doing, because the US markets, remember, yesterday and day before, no big gashes, but cuts nevertheless. About 0.25% for the S&P 500. The Nasdaq, 2 days on a trot now, has been leading the losses, down about 1/3% in trade yesterday as well. No surprises. I think the trade pessimism is blunting any kind of optimism, rate optimism that could be coming in, at least the market believing that there could be some bit of action from the Fed, but that is being blunted by trade pessimism. And until I think the G20 gets out of the way, you might well continue to see what this being the order of the day. The Asian markets too, awash with a bit of red. Again, no deep gashes. Hang Seng has idiosyncratic problems of its own, but Shanghai, Nikkei, etc., less than about 1%. So we'll have a start which is on those lines. Our markets too, I mean, just look at how the trade setup has been the last few days, and you will get a sense that that is what's been happening in our markets. One, the broader market has remained weak. In yesterday's session as well, the last 2 or 3 sessions, remember, we've had the advanced decline ratio, which is wobbly, despite volumes not being all that great. So volumes have been lower, cash market volumes, but the indices have corrected. Does Brent crude provide, or the NYMEX crude provide, a sentimental cushion? Maybe it does. With these prices, it's usually positive for India, but the world market's doing what they are, and our market's also looking slightly wobbly. You'd probably believe that that will not be a case this time around. And the telling part of the last few days has been that the weaker stocks are getting punished, pummeled, whichever term you want to use. I mean, look at any of these names: large cap, mid cap, small cap. The pain in these stocks is incessant. It continues day after day. For Indiabulls Housing, the Nifty name to correct 8% on 2 consecutive days speaks something. ADAG has been under pressure. Indiabulls, the entire group, has been under pressure, and it's happening on good volumes despite, as I said, the cash market volumes not looking all that great. So look at the price volume action there. I mean, you already know the price action, it's down. But look at the volumes compared to the 20-day averages. Indiabulls Housing, 3.2 times the 20-day average. Indiabulls Real Estate was an exception yesterday. Day before yesterday, the volumes were very high. Indiabulls Ventures, 1.6 times. Integrated, about 3.6 times. So these stocks which are correcting are falling on very high volumes on an average which is already higher. So that tells you something about the fear that is there in the markets right now with regards to some of the sketchy names. What would one watch out though for today? Because it's very difficult to figure out what the index does. We anyways don't try to predict what the index will do. It's a mug's game really. But what would specific stocks do? That's something that you can try and take a informed guess on, right? So the insurance companies would be in play today, I reckon, for the right reasons, because the AP growth numbers have looked pretty stellar for almost all of the private life insurance, save for ICICI. We won't dwell too much on it right now because I'll be speaking about it on First Word, but watch out for the private insurance players. Could be an interesting pack to monitor. However, specific stocks that you should monitor today. Firstly, the financial names, and UBS has come out with a downgrade on IndusInd Bank and Yes Bank both. Remember, UBS was one of the first bears on Yes Bank, always at a price which is consistently lower than the street. But their view on IndusInd Bank is interesting. They have downgraded the stock to a sell from a neutral. They have cut the target price to 1400 from 1700. They believe that credit costs are likely to surpass the current expectations. That's the key. There are other factors too, but this is that one key in that report of UBS when they have downgraded IndusInd Bank, and they've maintained the sell on Yes Bank. They've cut the target price though to a 90 rupees from 170 because they believe that the NPL risks are far higher than what the current expectations of the market are. So do watch out for UBS, for Yes Bank as well as IndusInd Bank. Then Jet Airways yesterday sank to a fresh life low. That's corrected about 60% year to date. Exchanges have now come out with some activity or some action on that. They're going to remove Jet Airways from the daily trading mechanism from June 28. Will be shifted to the trade to for trade segment. And after the corrections that we've seen, in order to curb the excessive volatility, this is being done. I don't know if it really curbs it because fundamentally there is a case for Jet Airways to do what it is doing. But let's wait and watch if this has an impact on Jet Airways or no. Reliance Nippon Asset Management, the strongest of those names, is in focus because Reliance Capital is planning to sell 2.86% stake. But the stock that could be impacted is Reliance Nippon Asset Management because there it's happening at a 3% discount to the floor price of 212 rupees. So Reliance Nippon Asset Management is a stock that you got to monitor. RNAM, a small discount to the current market price. Maybe it starts off lower, so let's wait and watch. Hindustan Foods is interesting, and it's interesting because not because Westbridge AIF has acquired 3% stake, but because 6 Sense Capital has sold. Now, 6 Sense Capital is Nikhil Vora's firm. They've earlier sold a large stake as well, another 3% being sold. He was one of the early acquirers and a big bull in Hindustan Foods for Nikhil Vora to get out of the stock. It's interesting. Now, the two large blocks that he's done in a spate of 3 months or 4 months in the Hindustan Foods. Should be interesting to see what this one does in the session today. And lastly, as we said, on Monday, these stocks were already under pressure, the oil and gas names, but it's finally official. The Norwegian government official has confirmed that the government will sell stake in IOC, ONGC, Oil India, and Reliance Industries. Let's wait and watch if these stocks are under pressure today. Whether the sale happens today or in a matter of the next few days, whether it happens via a block or no is anybody's guess. But on the news, do the stocks react or no is the thing that you got to monitor. Well, let's tell you what's lined up on First Word today. Collection of the top editorial stories. Firstly, Somit joins us to take us through Pricewaterhouse resignation letters as auditors of Reliance Capital and Reliance Home Finance. They tell you a story, I must tell you. Agam's then joining in to talk about DMart's latest strategy for growth and how the focus is back on large format stores. Darshan tells us what's ailing Natco Pharma for the stock, which used to be a darling, to correct 50% from its highs. And private insurers are a happy lot right now. I explain why. Pricewaterhouse resigned as the auditor of two Reliance Group firms 3 years before its terms were coming to an end. The firm, in its letters to the management and audit committees of both the firms, cited a number of issues. Somit's gone through the resignation letters submitted by the auditor, joins us for more. Somit, how did the events shape up and what is the telling part of these letters?
So it's all started out in February when PwC began its audit work for financial year 2019. Now, according to the resignation letter, PwC noted certain observations and transactions which in their assessment, if not resolved satisfactorily, might have a significant impact on the financials of both the companies. So they raised these issues with the management of the company. Now, as the auditor did not receive satisfactory response from the management of both the companies, that is Reliance Home Finance and Reliance Capital, they sent out these letters to the management and audit committee under the section 143 subsection 12 of the Companies Act 2013, read with Rule 13(2)A of Companies Rules 2014. So for Reliance Home Finance, they sent out the letter on April 18th and for Reliance Capital on April 24th. So what these two sections means, the first one, that is the 143(12), now that says that if the statutory auditor has reasons to believe that a fraud is being or has been committed in the company, then it must must report to the company's board and subsequently to the government. And the Rule 13(2)(a) rules lays down the procedure in which the auditor must inform the board and the government. So the auditor is bound to inform the company within the 2 days on suspecting an internal fraud, following which it has to seek a response from the audit committee and the management within the next 45 days, and following that it has to submit it to the government irrespective of whether the audit committee and the management respond to that letter or not. Now, post these 2 letters, the 2 companies disputed the legality of the letters and did not call for an audit meeting as it was required within the 45 days, that is the stipulated time period. Now, the companies also threatened the auditors with legal proceedings, including civil and criminal proceedings. Now, in Reliance Capital case, the company also said that if PwC were to file the ADT4 form, that is the format in which you have to report the fraud to the central government, it would amount to a serious misdemeanor and misuse of PwC's position as the statutory auditor of both the companies. Now, Reliance Capital, in its response to Bloomberg Quint's query, said that the reasons given by PwC for the resignation do not include any suspicion of fraud. They again said that they do not agree with the reasons given by PwC for the resignation, and the company has duly responded to the various observations raised by PwC in its letter. Now, audit committee, they also said that the audit committee had duly convened its meeting on June 12, that is yesterday, as we had seen in the exchange filing put out by Reliance Capital and Reliance Home Finance.
Okay, telling statements, all of these. Sumit, thanks so much for putting that into perspective. I would urge viewers, though, that if you want to know more about audit issues, there's a wonderful show that we did yesterday. It is there on the website as well. Do log on and try and see. It's a long show, about 1 hour, 10-15 odd minutes, but gives you complete insight on what are the issues that are grappling the audit firms and this whole audit space. It's playing out at 10:30 a.m. today. So for all of you who don't want to go to the website and search for it, at 10:30 a.m. you can go out and try and read that show, see that show as well. The next piece on First What is on Avenue Supermarts, which plans to add nearly 30 stores in FY20 and larger ones than that to help drive growth. In an analyst meet yesterday, the retail chain laid out its strategy that involves store expansion, changing product mix, and much more. Agam Vakil is standing by with the highlights. Agam, what stood out for you?
Well, among the most important factors, Neeraj, was the fact that they're being very tentative when it comes to its online business because it's a big cash burn business. But let me just start off by talking about their plans when it comes to store expansion. So, as we can see, the company has mentioned that they did add around 21 stores in FY19, and this was perhaps not as per their expectations, and they very well could be a little more aggressive going forward. And on the back of that, Prabhudas Leeladhar is projecting about an addition of around 20 stores in FY20 and about 30 stores in FY21. So we're most certainly likely to see the number much higher than what we have been used to as far as FY19 is concerned. Another very important factor that the company mentioned was the fact that the new stores that came into play in this particular year, the average size was around 46,000 square feet. Now here the management mentions that what they intend to do is to, if they do have larger stores, it will mean more throughput in the long term, and that is what they would be ideally be looking for. They are also increasing their realty acquisition, and they are only going to consider lease models if the leases are also in the long term. So of course all these factors are very much in play, keeping in mind not just the next few years, but much longer than that. Now, as far as your clusters are concerned, the northern cluster is relatively new, which is why there's been a little bit of slackness there. But when it comes to its mature clusters in the west and south India, they continue to do well. There's been a lot of pickup, and based on that, while the total store addition stands at 21, we've seen 8 stores being added in Maharashtra, 4 in Gujarat and Karnataka, and these are some of the bigger states where it has a relatively larger presence in. But moving on to your e-commerce, now the company has put in substantial amount of funds in DMart Ready, And while the revenues have risen by, well, they've almost tripled, if you can see, from 44 crores last year to 144 crores this time, well, the EBITDA loss has been relatively stable, so this of course can be taken as a positive, which means that the company is being relatively more responsible when it comes to investments in the e-commerce space right now as compared to, well, several other companies, if I can call it that. But when it comes to DMart's revenue shares, and this is something that the company is going to focus on, improving product mix, and within that product mix, foods, non-foods, which will, however, have FMCG items, and of course, general merchandise. And as you can see, the highest share will be foods, because the company essentially majors in groceries, and of course, general merchandise, which is, well, the next in line in terms of revenue contribution. But moving on, well, this is Avenue Supermart's same-store sales growth. The company has suggested that they are, well, relatively happy with the way same-store sales growth have panned out, essentially coming on the back of 14% last year. And well, there could very well be a little more improvement in stock, considering they're going steadily and they're not aggressive in expansion in their stores. As far as revenues go, again, well, this has been something which has been known. They are looking at very, very steady growth because they've been very careful in terms of expansion. And finally, coming down to your operating margins. Gross margins remain stable. They are also suggesting that for now, operating costs in their brick and mortar stores are much lower as compared to the e-commerce. And while we have seen margins come off from last year, they're still steady and well, much improved as well at around 8.2, and this will continue to be. They're not expecting any major changes in gross expansion. On the whole, a very stable and very measured outlook for the upcoming year, Neeraj.
Okay, stable, measured outlook. Let's hope it also translates into holding up the valuations, because the stock has seen a bit of a correction. But Agam, thanks so much for putting that into perspective. Agam and team will also be going out to meet the management in a couple of weeks from now and try and get assessment of what else needs to be known about Avenue Supermart. So, well, you can expect some more stories around this on the site. Of course, a story around what the management has said in the analysts meet will be up on our website, bloombergquint.com, soon. So you need to tune in for that as well. The third piece on First Word today is on a pharma stock, which used to be a darling of the investors. Natco Pharma is under the weather though now. The company's financials have weakened over the past few quarters, and it's reflecting on the stock as well. Price is corrected over 50%. Yes, 50% from its all-time high. So what's plaguing the drug maker? Darshan is here with an analysis. Darshan, used to be a darling really, but suddenly it's just gone all right. The story's gone all right.
Yeah, so basically a few years ago, everything they touched turned into gold. They were doing extremely well. The stock price, actually, it was actually a multi-bagger in sorts. But of late, there has been a big sell-off that we've seen. First of all, if you're looking at it, it's down almost 50% from the all-time high. And valuations now are at a 40% discount to its 5-year average. So valuations have come off significantly. The analyst community, however, remains bullish. But we'll try to talk about. I think the financials have deteriorated. If you take a look at what's happened over the past few quarters, the financials, the revenues have moved in from levels of 780 crores to almost 450 crores, and the EBITDA has also come off significantly for the company. The other part is the margins. If you're looking at the margins, from a 50% margin, they've come down to margins of almost 32%. So there is clear weakness that's been seen on the financials. The expectation also, if you're looking at what the analyst and the Bloomberg estimates indicate, is that over the next 3 years, margins and the EBITDA will be muted. So if you look at EPS, it will stay same at the levels of 35 for the next 3 years. Revenues, however, will see a growth, but EBITDA is expected to see not much growth. So majority of the analysts say that growth probably will come in now only after FY22. So that's the trend. Now, what's gone wrong and what's impacted? First of all, the big story was about the 3 or 4 drugs that they had. Copaxone was the big drug, but its partner Mylan took sharp price cuts in Copaxone, and they haven't certainly been able to dent Teva's market share. So they have been able to take some market share, but the scale up of Copaxone was not very, very high for Natco Pharma and Mylan. The second part is they grew rapidly over the past few few quarters because of the exclusivity in generic Tamiflu. Now, since that has also gone, revenues have come down drastically for this drug. So that is something that has also impacted. There is significant amount of pricing pressure in the domestic hepatitis C segment. And finally, there is no major drug launch that will happen for the next 2 years. So for the next 2 years, earnings probably may be range bound or will be muted. Now, what do you look out for Natco next? What are the 3 or 4 important parameters? First of all, Revlimid is the biggest drug. The street anticipate that will come in FY22, and that's the big trigger. But they're still awaiting the FDA nod for this one. Secondly, they're looking at scale up in domestic cardiology and diabetes market. That is what the management has been saying. And now moving away focus from the US markets, they're focusing more on Brazil and Canadian markets and moving on. But at least for the next 2 years, it seems that earnings will be muted, and that's why a lot of people have started moving out of Natco Pharma into other companies.
So are you saying, Darshan, that from April 2019 till March 2021, there's a possibility that earnings will remain muted for Natco?
So we showed that earnings, expected earnings for the next 3 years, EPS will remain pretty much at the 35-36 level, EBITDA pretty much at the 800 level. Revenues no doubt may grow, but that high margin drug, so the EBITDA will spike only because they get an exclusive drug, because that's what Revlimid is for, and the street anticipate that will probably come in FY22. So for the next 3 years, when I
3 years, yeah.
So FY2020, probably in FY22 it may start coming. That's what this thing. So if you see what the analysts are saying, most of them are still bullish, and they are now bullish. Or majority of them have a buy, and they're bullish because valuations now are at a 40% discount. So they're saying that could not be, but they believe that concerns are still there, and a lot of people have moved out because the visibility, earnings visibility, at least for the next 2-3 years, was missing in Natco. So majority of them, there's a 27% upside on Natco. Almost all of them have a buy. There is hardly a sell. There's no sell. There's one hold there. So the reasons indicate that valuations are attractive, but earnings growth probably is still missing for Natco.
Yeah, where is the growth? I wonder. And for 3 years, if indeed the EPS pricing is where it is, wonder what kind of multiples you want to
is
get.
an investor. He has a stakeholding in Natco also, and that's because Natco, when Natco started, then Sun was scaling up. Natco sold a lot of its business to Sun Pharma.
Okay,
that is how, and then it went out of the market and then came back into generics. That's how the association with Dilip Sangvi and Natco is.
Okay, interesting. Darshan, thanks so much for putting that into perspective. But that's got a telling chart, isn't it? Or that at the table, which shows how that for the chart, yes, but the table as well. FY20, FY21, FY22, you have hardly any EPS growth for a company, and that's quite telling, really, for not a large-size pharma company, but a mid-size pharma company at best. Anyways, time will tell. It may not be great times for Natco, but private life insurance companies have had a very decent month of May. Now, I just want to bring to you what has happened in terms of the annualized premium equivalent growth numbers for the month of May. It was a very strong growth. So, AP growth for the private insurers at large was up about 31%. This was versus 1% YOY AP growth in the month of May 2018. Why this is important is because this 31%, as strong a number that it is, it's coming on a very low base of just 1% in May 2018. So you've got to keep that in mind. Having said that, 31% is strong. For LIC, the AP growth was 15%, which means that for the overall industry too, 23% AP growth. The reason I bring this up and why I believe it's so important is because a rising tide would carry all boats along with it. So you'd be worried if the non-private life insurers are not growing and only the private insurers are growing. But it's a great thing that both the private and the non-private or the public life insurers like LIC are growing, which is a good thing. And the strong AP performance by select private companies, so HDFC Life, Kotak Life, Tata AIA Life, and SBI Life are the 4 names that have had a very strong growth. Now let me take you to the numbers. One of them is on the screen already. The AP growth data for the month of May for the 4 listed names. HDFC Life, look at that number, 62% AP growth. SBI Life about 37%, ICICI Pru a muted 12%, and there are reasons for the same, I'll come to them, and Max Life about 23%. So you can see by and large all the companies did well save for ICICI Pru, but HDFC Life staggering May APE growth numbers, and the market share for the private insurers also improved. You would have made that out, right? The overall industry growing at about 23%, but LIC growing slightly lower, so the private life insurance gained market shares. HDFC Life overall market share up 225 basis points, SBI Life up 108 basis points. ICICI Pru went down about 76, and they've had some issues in the month of May as well, despite the private space doing well. But the overall private insurance space continues to gain market share. Naturally, so you would add at 323 basis points higher. Now, what happened to individual companies? That's what you would be wanting to know. HDFC Life, APE growth of 62, I said 62%, 61.8%, so nearly 62% YOY in the month of May 2019. It was the robust growth for the second consecutive month. A lot of people ask about why is it that HDFC Life gets the premium multiples that it does. It's for this precise reason. The retail APE ticket size for HDFC Life, and note this number because I'll make the other numbers, bring up the other numbers as well to show you just how impressive this number was. The ticket size was up 56.4%. There was substantial traction in the non-par annuity products. What I mean to say is that all companies grow in insurance in the annuity products, which are standard routine products which everybody subscribed to. But HDFC Life came out with some non-par, which are slightly off the beat annuity products, which would have seen substantial subscription, as a result of which the ticket size went up for HDFC Life in the non-par space as well. So staggering growth, 56.4%. Now compare that to the second best performer, which is SBI Life, APE growth of 37.3%. Again, very robust. Don't compare it to HDFC Life, but very robust number indeed. In May, the retail APE ticket size was up about 8.1%. Which is not a bad number, by the way. It suggests that there is a push for the traditional protection products, which is what I said. Look at SBI Life. I'll also come to Max. There, the numbers are a bit more sedate, which sees that there is a push which has come in for the traditional protection products. Just that in HDFC Life, there are the non-par products which are doing well as well, which is why their number is 56%. If I can actually get in, okay, let's go by the order of size, and ICICI Pru Life is the third one. But in the APE growth, 12.3%, not as great as the other two, but 12.3% there is growth. It's lower than peers, yes, but the retail ticket size, the APE ticket size, fell by about 4.4% YOY basis. So not in that fashion, on a relative basis, it was not the best month for ICICI Pru, and which is why compared to the other two piggies, it trades at a discount. Max Life, not the biggest name, but slowly getting there. APE growth of 23.6%. Again, the retail APE ticket size of 13.7%, which again, like in the case of SBI Life, suggests that there is a push for traditional protection products. So having seen the four names, you would have guessed that HDFC Life by far has had a substantially stronger month, with SBI Life close behind and Max Financial not doing too badly either. But which brings me to the multiples and the reason why these multiples stay the way they are. Look at the FY20 embedded value in rupees billion, and then the valuations, the price to embedded value. This EV is the embedded value in the case of an insurance firm. Look at those numbers and they tell you a story, don't they? HDFC Life, 440 consistently sees buying despite the fact that it's trading at 4.1 times embedded value. This is, of course, as per a JM Financial report. Other brokerage notes might differ a little bit, but by and large, these are the ballpark numbers. SBI Life, 2.7. A lot of people argue that it is undervalued compared to HDFC Life, despite having enough touch points and good strong growth as well. But somehow HDFC Life continues to do well. ICICI Pru Life, it's recovering from the mess that it was in the last 2 quarters of FY19, but trades at a discount to the other two for precisely the reasons that it is in a recovery mode. And Max Life, because of the size, has this disadvantage, and therefore, look at the embedded value numbers. Now that tells you a story, just about 10,000 crores, a stark discount to the others. But it's slowly getting some valuation traction now, because the growth numbers for Max Life 2 have been improving. 1.6 times as per JM Financial, MK and Jeffries peg it at slightly lower numbers. But overall, if you go to look at it, the AP growth numbers for the month gone by for private life insurers by and large has been pretty robust. Let's see if they have some bit of traction or no. Lastly, the NBFC space has been having a tough time with the liquidity crunch going on and certain companies being downgraded on default. So where are NBFCs headed to? To talk more about that, we'll be joined by Sudhin Choksi, Managing Director of Growth Finance. So this is the end of First Word. We'll have this conversation at about 9:30 or 9:45 a.m. and lots more on the day's trade on the other side of this very quick break. Stay tuned to Bloomberg Quint Live.
Everyone